What does $70 WTI say to you about global growth?
It'll definitely stimulate it relative to 85, 90. But I think, yes, you're right. It did sell off based upon concerns around China. But the data disappointment was a PMI that was expected to be 49.5 and came out at 49.1. Does that justify the oil market being at a record short? Absolutely not. No, I'm not going to argue Chinese demand growth is robust in any shape or form. And yes, they have structural problems on the longer term outlook. But by all means, it's not a collapse that would justify the market being as short today as it was in the global financial crisis of '08. So you got to ask, what's going on here? It's something far deeper than a slowdown in China, because when you look at this market fundamentally, inventories are low. The forward curve today, even after the sell-off, is backwardated, and a very high level of backwardation, which is consistent with a very tight, fundamentally strong market. And then the third issue is concerns around OPEC bringing on supply. They're bringing on a small amount that is being completely compensated for by decreases out of Kazakhstan as well as Iraq. And given the credibility of OPEC recently, it's going to be important that that credibility is maintained. So I think these fears need to be put in the context of what the physical market looks like, which is relatively robust. Oil is more volatile than most of the other sectors, so it has an extra cost to holding it. We estimate that to hold oil with a risk-free return of 5.25%, which is where the money markets are paying you right now, you need a return in excess of 14.25%, call it 15%. A 15% price move at a $75 price level means somewhere around, $10 or $11 a barrel. And then, so your expectations have to be for a big upward move before you're going to own it. Now with the sell-off down to 73 on a Brent basis, the probability of seeing that upside is now much more likely. You're probably going to see investors pull money out of the money markets and put it back into oil. But when I talk about the borrowing costs in being short oil, essentially by drawing down your inventories to very low levels, you're leaving yourself very exposed to being short if something were to happen, like a demand surprise to the upside or some type of supply shock. Then the physical guys would have to come in, cover that short, which means increase the demand for the physical barrels. And then you look at the paper inventories, call it working capital of physical oil, working capital of financial oil. They're also short the financial oil. And so when we look at the market today, you have record shorts against really low inventories. That historically doesn't happen. The only explanation for that is people are taking money out of this market, taking working capital out of this market and putting it into higher returning endeavors. Now with the pullback, you're likely to see some of that money come back in. You'll race back up. Part of the reason why we've seen the market go from, 73 up to like 92, back to 73, up to 92 is the investors got to be pretty comfortable they see a return in the oil market that's greater than what they can see elsewhere.